Hi there, John Tafoe at the brokerage. I'm joined with my partner, David C. at the brokerage. And David, how do we go about analyzing investment property for our clients?
Well, it's always overwhelming for people when they take a look at it and they don't even know the first step to begin. So we love using our little tool here, which we share with people. Anybody can download this for free. Some people call it back of the envelope, some people call it Proforma, but what we've tried to do is break down some really simple investment formulas that you can see here on tab 1, and then those trickle over to any property that you want to analyze. So when you move into the analysis portion of this, I'll make it a little bit larger so you can see it. You have to have some fundamental information here. And the fundamental information is stuff that you probably already know anyway. Like, what's the property taxes for a building? What's the common area expenses, the regime? Is there an insurance component to it, or is there general liability? And then you get the totals of it, and then you find out what it's going to cost you per month for that. And depending on how leases and agreements, all these things are structured, somebody's paying for the utilities. So you can also put that stuff in as well. And that's really the top of the funnel of information that you need. And then from there, it goes into, okay, well, what's the rest of the story? You've been an investor for a long time, John, and I think this was kind of an eye-opening experience even for you, as much as you've done it over the years, right?
Oh, absolutely. And as you know, for 22 years, I've been a back of the napkin kind of analysis guy. So I've been doing this for years, but it wasn't in spreadsheet form like this is. And I think this really makes, it gives you some good clarity on what you're actually gonna be faced with when we go from a tenant to a landlord, or tenant to an owner of property.
Yeah, not everybody's a cash buyer either. So the bank ultimately needs a story if you're going to borrow the money. The bank, this organizes information for the bank so easily. So let me break it down a little bit further. Say, for example, that this property here, it's a 2,600 square foot suite. And then we're just going to presume that there's one building that has both of these suites in there. So essentially you have a 5,300 square foot building, and you have two tenants in that building. And what people forget is that not everybody, even brokers, speak the same language about expenses. So some people say, well, it's a triple net lease, or it's a modified gross lease, and all those things are great. But I have found over the years, and John, I think you would agree from your experience working with us, is that everybody has a little bit different slant of a definition of triple net versus gross. I mean, how many times have we seen information that we thought we had all the pieces and we didn't really have all the pieces?
Oh, absolutely. Happens all the time, David. Somebody could be calling it a triple net lease, and then all of a sudden, oh, no, the landlord has to take care of the HVAC equipment. So there's a big expense there for a landlord if all of a sudden your HVAC goes out and you're faced with a $10,000, $15,000 bill. So you have to be really careful, dissect the language in the lease to see exactly what everybody is responsible for.
Yeah, and I think people that grab onto the definitions can make a mistake. So we try to stay away from referring to anything. Of course, we do make representations on, oh, it is triple net, but try to stay away from that and really just get all the information. And on the side that you're going to be responsible for, put that on the left sheet of paper. And then on the right side, put everything that the landlord's going to pay for, because the landlord that writes the lease, or the seller, or whoever, they have a history with the property. And somebody that's buying or coming to a property that they may not understand, they don't have that history. So you just have to make sure that you get all the information boiled down. But let me break it down even further, is that we have, and if you use the spreadsheet, anything that is in yellow, you can type that in and populate. The green will absolutely populate for you. But when you pull in all the information, it just flows. You just go from this section to the next section to the next section, and it will all just flow together. So by the time you get here, here's really the payoff, right? Is the crux of the information. When you get down to the analysis here, this is what is really on everybody's mind when they're talking about the back of the envelope. And this just goes back to the first sheet where all the formulas are. what are the cash flow from operations? Like, what is all the money that flows into the property? And then this particular situation, if it's 134,000, then what's the mortgage payment? And we do that using our financial calculator. So if you ever run into a little problem like, oh, I don't know how to fill in that box, just let us know and we'll run the quick calculation for you. Because what you can see is that it doesn't have a lot of cash flow, but it's breaking even. And why would that matter? An investor wants a certain thing. An investor wants a certain rate of return. You might have an investor that's a cash on cash investor who only cares about, if I put in $1, I want to make $1 times 1.5, right? But you may have people that want an internal rate of return and all these sophisticated terms that can lose people. But the real thing is that if you're a tenant today and you are renting real estate, if you could have the same net effect, the same feeling of, well, I'm paying this, but you don't own it, versus paying the exact same thing and that you own it. John, how about the time we run those calculations where we say, what are all your expenses? And did you know you can afford this amount of real estate? People blown away.
People's eyes light up. Our clients' eyes light up when we say, okay, look, you're spending $7,000 a month on your rent and all of your expenses here. And we could buy this building and your expenses are now $5,000 a month. Plus you have other income from maybe some other tenants. It's just a wonderful thing. And then you get to take advantage of all the tax implications like depreciation and all of that, and the appreciation of the property too over time. I say it all the time, there's no better investment than real estate.
Yeah, and if you want to go to our YouTube channel and see our expert interview series, we actually have a recorded session with Brian Kurtz who can walk you through all the depreciation benefits of the real estate. But the big pivot, I think, that blows people away the most is, and you don't see this a lot, when there's a portfolio analysis of people that have bought multiple properties. So it's a very simple concept. Let's say you go through this whole spreadsheet for one particular property, right? You fill out everything here, you have your analysis, you understand what you have, but then you say, well, what about that next property and the third property? Or what if you already have 10 properties? What if you have 10 properties, but you don't really know how the net effect of the portfolio works? It is so simple. We'll do this for you as a courtesy. All you have to do is give us the information. Think about it like this. This example property is a lot of information that's in a one-page view. It's a lot, but you could take that same information and you could boil it down to just a different view on this type of sheet here. So if I've completed this, then this essentially could be one property, right? And so if this is one property, and then you decide, well, wait a minute, but I have 10 properties, then all you would have to do is to basically replicate that process, right? And once you replicate that process and populate all that information, then all these things taken together essentially will give you a portfolio approach to your investment real estate. And you see the portfolio approach all the time if you're dealing with stocks and bonds or anything with your financial advisor, but it's rare that we see it in real estate. And what if you have a property that you're thinking, well, that's not really performing? Well, maybe that's the one that you need to sell and do a 1031 exchange on. Like looking at this, but never taking the time for real estate to get super granular and detailed, I think you miss a lot of opportunities to evaluate for a portfolio.
Absolutely. And unfortunately, we hear about this all the time, David. We have investors that buy, say it's a single family home and lease it out, but they end up losing money on the property. Yeah. They come to us all the time and say, hey, what should we do? Well, number one, you probably have room to raise your rent because rents have skyrocketed in the low country, as we all know. Or yeah, maybe it's time to sell that property and move on to the next.
Yeah, and we just don't look at properties, not even an annual review, right? If things are going well, people are not calling you saying there's a leak or the air conditioner's out, you really kind of go numb to it. And you just think about it when the property tax bill comes around and you don't really give it an annual or biannual analysis. And that's a big miss, I think, because when you look at this, and if your goal is to create wealth with passive income real estate, you can come up with multiple strategies. How about, okay, if we have 4 properties in this scenario, let's focus on one to pay off over the course of the next couple of years, and let's let the others kind of run their course. But let's see if we can get any excess. And if you meet with your CPA or your tax advisor and they have a very clear view of all of these things, then you can get some real advice to know how to go behave and to go do that. And when you amass enough properties, that's when you can go back to your property and casualty insurance broker and you can say, hey, is there an opportunity for me to get some benefit of portfolio insurance instead of just each property having their own property and casualty policy? Then you could get a portfolio, which gives you a better deal on your insurance across all the properties. And then you study these a little bit further and you realize, well, look, if I had the same people managing all these properties for me, then I could drive down the operational cost. Once you own a property, it's not so passive if you're trying to increase the cash flow, is it, John?
No, I don't like that term, David, passive income. So there's nothing passive about owning real estate. You've got to be involved. Otherwise you start losing money, like you say. So yes, it is passive in the eyes of our government, but there's nothing passive about owning real estate. However, there's a lot of help out there for you. There are great management companies. We can put you in touch with some good ones. We can do it ourselves in-house. So just give us a call.
Yeah, and I think it's important to know that, John and I both have properties, and sometimes we will manage our own properties given the situation. And sometimes we'll let another management company, even though we manage, we'll let another management company go ahead and manage it. Now, why would you do that? Well, say you bought a property and the management is already in place. What if they're doing a fantastic job and they're active and they're bringing expenses down and they're actually showing you ways to improve and they know the asset very well because they've been managing it, and for a nominal fee you can keep them? You should contemplate that at that point in time, but you have to run the drill of these 3 steps, right? Understanding how the formulas work, understanding how each individual property underwrites, and then roll it into a property portfolio management theory that really will open your eyes to this. So John and I wanted to send this to you today.
Point, Dave. Let me jump in real quick on that. Banks, when they're underwriting, no matter if you're self-managing or if you hire a management company, they will build into their underwriting, their Proforma, a 15% management fee. So when they're writing this loan, you might say, hey, look, I'm going to be clearing this other 15% because I'm going to self-manage it. But in the eyes of the bank, you're still hiring a management company for that 15%. So somewhere you have to make up for that difference.
Absolutely. Absolutely. And there's so many more tricks that you can do talking to your CPA. If you have responsible children, adult children, they can be doing work and then become contractors to the management company. Look, we want you to do everything above board. That's the only way we operate. You should be getting advice with your CPA, but you have to have the conceptual structure in place first to wrap your mind around how to increase the profitability of your real estate income. So we wanted to share this with you today. Look, I'm David C. I'm the broker in charge of the brokerage, and I'm here with my partner, John Tafoe, who has an extensive background in building wealth through owning real estate. And together, we've been doing this for our families for a long time. We want you to have this resource, and we also want to be available to you to ask any questions. So feel free to reach out to us with all the contact information here. We want to give you this information so that you can become a better owner, a better moving from tenant to owner, and then a better real estate investor. John, anything to add before we part ways here?
No, like I always say, real estate is the best investment in the world. Give us a call. You can reach me at 843-813-1228.
And I can be reached at 843-364-6720. Thank you very much. Have a great day. You win here at the brokerage.